Let's talk about Vanguard Dividend Appreciation Index Fund ETF, ticker symbol VIG. It currently has a value of just under $79 billion in assets and is incredibly popular. Part of that popularity comes from its very low fee structure, which is 0.06% in annual expenses, or a mere $6 per year on every $10,000 you invest. If you watch my video on SCHD, both funds have an expense ratio of 0.06%. While SCHD has a dividend yield of 2.92%, VIG has a dividend yield of 1.6%. VIG is fairly straightforward in its strategy and is focused on the largest 250 or so dividend pairs in the US, led by tech giant Microsoft Corp and healthcare icon Johnson & Johnson, with a median market cap of $160 billion across its holdings. This reliance on big-name stocks may not be a bad thing for investors who want to reduce the risk and focus on entrenched income investments, however. Although SCHD, which is a fund I really like, has a higher dividend yield of 2.9% compared to 1.6% for VIG, one could argue that VIG is invested in slightly safer stocks. So if you are deciding between the two, you have to decide if you want slightly safer or slightly higher dividends. Not that SCHD is unsafe by any means. Both funds have performed well. VIG is made up of 267 stocks. There are no foreign stocks. Let's break it down by sector. Alright, communication services at 2.4%, consumer discretionary 10.7%, consumer staples 14.3%, financials 14.7%, healthcare 14.8%, industrials at 15.3%, information technology at 19.6%, materials at 5%, utilities at 3.2%. VIG's top 10 holdings make up 30.9% of its portfolio. At the top, we have Microsoft Corporation, then United Healthcare Group, Johnson & Johnson, Procter & Gamble, JP Morgan Chase, Visa, Home Depot, Coca-Cola, Broadcom, and last we have Costco. The VIG fund provides reasonable income, but it's nowhere near the level of income provided by VYM. The difference is made up in the returns over the long run. 10 years of consecutive dividend growth is required to be incorporated into VIG, and REITs are excluded entirely. Starting early is the most important thing you can do as a dividend growth investor. During your accumulation years, the goal is to buy stocks with a good history of increasing their dividends. Using an ETF like VIG can accelerate that growth too, since it efficiently rotates into the highest yielding stocks for hardly any cost each year. And like I said, it has lower dividend yield than SCHD, but VIG is also subsequently less volatile, which could appeal to many. VIG's revenue and earnings growth rates are well behind that of the S&P 500. Analysts expect revenue to increase 8% compared to 14% for IVV. VIG doesn't include high-growth stocks like Apple, Google, Amazon, Tesla, or Facebook. It also doesn't own energy stocks like ExxonMobil or Chevron, which could help insulate a portfolio against an inflation-led recession. Since inflation and higher interest rates concern me, I wish this fund offered more defense against such a scenario. The 10-year dividend growth requirement helps the safety score, but it also prevents you from holding other excellent stocks like MasterCard, Morgan Stanley, and Charles Schwab. To illustrate, there are 157 securities in the S&P 500 with a 5-year dividend growth rate above 10%, and their average 5-year total return was 148.48%. So like I said before, you are trading some great stocks in higher yield for safer and less volatile. I hope this video has given you enough information to make an informed decision whether or not VIG is right for your portfolio. Don't forget to subscribe for more videos like this and to help me grow my channel.